Good day, my name is Dean Crocker. I'm a senior equity analyst with the PSG Wealth research team, and today I'll be taking you through our latest EIA completed on Wells Fargo. So just under the narrative of the US banks, we focus quite a bit on Bank of America and JP Morgan of late. JP Morgan and both bank released their results. Morgan took a bit of a knock on the back of that, while bank seems to have held up a bit better. It does seem like there's a bit of pressure coming through in the banking sector in the US, despite the fact that there's increase in yield curve. We'll spend a bit of time on that in the latter stages of this presentation. But on the back of that, we decided to look at the greater horizon and look at some of the regional banks in the US, and that led us to Wells Fargo. So just in terms of the executive summary, these are really the few key points I want to leave with you. The results were strong. They did beat expectations across the board. This was largely due to a few once-off events. There was the provision release of, call it, $875 million. There was also an impairment, which was negative to the results, about $268 million. And then finally, they sold off their corporate trust services and Wells Fargo asset management business for just under $1 billion, which was $943 million. These all had a material impact on the results. So we did, where possible, try and exclude them from our analysis. On the back of that, we did still get to the more or less similar conclusion. So the four key points, the pre-provision and tax profit, nice key measure for all the banks, was up 35.5%, or beat expectations by 35%. It was up 38% quarter on quarter. There was very strong loan growth, called 4% higher, whilst the deposits remained relatively flat. Now, the reason deposits stayed relatively flat is there's still that asset cap that is in place. Now, I'll spend a bit of time on that a bit later, but effectively it just has to do with some previous irregularities and the Fed effectively slapping a nice asset cap on the group so they can't breach certain value. We are seeing rising bond yields. Now, there is a bit of talk around the 10-year and the manipulation from the Fed, given that they continuously buy back bonds. So there is a slide on that, and we'll spend a bit of time on it. But nonetheless, it is still a tailwind for future. As I mentioned, there's that once-off income, and that materially impacted the results, making it a little bit difficult to compare on a quarter-to-quarter basis. On the back of all of that, we have calculated intrinsic value of roughly $59.77, which implies about 14% upside at the time of completing the EIA. Right, so looking at the event, it was the fourth quarter results, so really strong revenue growth supported by nice higher net interest income. The net interest margin is still below the 5-year average, and there is some headroom to be made there. In terms of pre-provision income, as I mentioned, that's 38% up, and it beat consensus by 35%. Now, the reason it is so much higher than consensus is that it does include a portion of the sale and the benefit of the sale of the corporate trust services and Wells Fargo asset management business. In terms of efficiency ratio, that has really improved quite significantly from 71% to 63%, and it has been a key focus of Wells Fargo over the last few years, really their cost management of the group. So they're really improving the efficiency, and they continuously talk to improving it going forward. Earnings per share is up 18% at 101.38 cents, while the book value per share was up marginally at 2%. Table below, you can see the main area to highlight there is just in terms of expectations relative to consensus. They have beat them really across all main components. Final point is really just on the provision of credit losses. So that is continuously from the previous period. You can see it's actually declining. Shows you that the release in the third quarter 21 was a lot larger than that of fourth quarter. But it does seem like they still have a few excess reserves in terms of the provisions, probably roughly about $3 billion. It doesn't imply that they'll continuously release it, and if they can, potentially release it. But it is just relative to pre-COVID levels, there's some margin remaining. In terms of the impact, so on the data release, the share was up 3.8%, 3.68%, so it did beat or run ahead of the Dow Jones, so reacted positively. Wells Fargo, on a year-to-date basis, is up 15.8%, implying that they've outperformed the benchmark by 20.2%. So now, just in terms of the assessment, as I mentioned, the yield curves has been always a key component for the banks in the US, and generally they do track the 10 to 3 month yield spread. What we are seeing, and you can see from the graph, there's still quite strong correlation. But what we are seeing is that the 10 3-month yield spread is a bit suppressed because the 10-year is so inflated or controlled, I think probably the best word to use, by the Fed, in the sense that they are buying so much back. They are continuously playing in the bond markets and the repurchase markets. Through the stimulus packages, they have manipulated or effectively suppressed the yields. So the market hasn't really been able to, or the 10-year yield curve hasn't really been able to reflect what the market is saying. If we look at it on a 10 relative to a 2-year basis, we are seeing a decline in yield curve, which is a bit of a concern, but it really is systematic of the fact that the US and the Fed is just still hampering the yields on the longer term duration bonds. In terms of the assessment, so it really is, it's a regional player. It offers an alternative to JP Morgan and Bank. It has a lot of characteristics similar to that of Bank, probably trading at a bit cheaper levels, and one could justify that due to the fact that, the big two are really just in everyone's portfolio. Excess provisions reserve, there's about $3 billion left, as I mentioned. Probably not likely to be fully released anytime soon, but there is still that margin that they can utilize. There is a rise in yield curves, as I mentioned, the increasing on the 10 3-year and the declining on the 10 2-year. The asset cap remains in place. It has resulted, and it's really a thought process, really has resulted in a lot more efficiency in terms of the Wells Fargo asset or deposit base. If you look at the deposits, they are sitting with call it a non-interest component of the deposits at roughly about 36%, which is similar to that of Bank, which is sitting at 39%, but JP Morgan only has a non-interest component of the deposits sitting at 27%. So the efficiency within the deposit base seems to be very, very great and very strong, which in an increasing interest rate environment, you really want to have a stronger component in terms of your assets when it comes to interest sensitive securities relative to that of your deposits. So what we're also seeing is that the loan to deposit ratio in terms of Wells Fargo is also a lot higher than the two competitors, sitting at 60%. So that's implying that a lot more of their assets are sitting in loans. On the back of that, we have calculated an intrinsic value of $59, call it 11.4% upside. Now, just in terms of calculation for the implied intrinsic value, you can see on the right-hand side the two tables. The first table is just our mean revision table. And what you can see is that on a Wells Fargo basis, on a price to book, trading at roughly about a 1.3 times relative to its longer-term average of 5 years of 1.2 times. So it is a little bit flat, implying fair value on that basis. And relative to its peers, this also seems to be fairly valued. When we completed our intrinsic value calculation, we looked at the book value per share out for 1 year based on consensus. And we applied a bear-based bull case scenario analysis. Now, if you look at the figures in terms of that, you'll see that we've weighted it heavily towards the base case scenario, which is 1.34 times price to book multiple. That's very similar to where they're currently trading, as well as their peers. So we feel that that weighting is probably more reflective of their longer-term average. The bear case was that of COVID. So the likelihood of that occurring is far less likely than both the base and bull. Hence why it's only got a weighting of about 20%. You could probably justify slightly lower, but 20% is what we've utilized. Bull case scenario, that is really the early 2000s when the banks in the US really ran hard. That is probably a little more likely to occur than that of the bear case, hence why it's got a 30% weighting. Now on the back of that, we've calculated a weighted price to book of roughly about 1.31, which you can see is just slightly above its current valuation, or its current multiple, but above that of its 5-year average. And on that, we've calculated the intrinsic value of $59. So just in terms of final remarks, Wells Fargo, it's a nice regional player. It does offer alternative to the two bigger banks, the Bank of America and JP Morgan. It does carry excess provision reserves, so it has a bit of margin of error that it can utilize in its financials going forward. It's shown improving efficiency ratio, which is something you haven't seen from the other two banks. Particularly JP Morgan saw a significant increase in their costs. So maintenance of the cost at the moment, particularly given that the income component isn't really generating that much and running that hard, is very important to generate bottom line. We do feel that they are well placed to take advantage of the rise in yield curve. We believe that asset cap has made the balance sheet a lot more efficient than that of their peers. It does seem that they are a lot more aligned toward interest rate movements, particularly on the asset side, and it should benefit them in the short to longer term. With that in mind, we've calculated intrinsic value of $59. There is about 11.4% upside. If you'd like to place a trade, please speak to your financial advisor. Alternatively, you're welcome to speak to our trading desk. Please take note of the disclaimer and have a great day further. Thank you.